The ancient Greeks told a story of a king so obsessed with wealth he was granted a wish that everything he touched would turn to gold. King Midas was ecstatic at first. His food, his drink, his own daughter all turned to cold, lifeless metal. This myth isn't just a children's story. It's a timeless warning about confusing the symbol of wealth with wealth itself. And for millennia, no symbol has been more potent, more seductive than gold. For thousands of years, we've been drawn to its siren song. We've dug it from the earth, fought wars over it, and adorned our most sacred objects with it. Today, that ancient allure has a modern name: investment. The world's central banks hold over 35 metric tons of it. Your neighbor might have some buried in their backyard. The financial news talks about it breathlessly every time the market gets choppy. The core belief is that gold is a permanent store of value, a financial fortress, the ultimate safe haven in a world of uncertainty. But is that belief based on timeless wisdom? Or is it just an ancient myth we've failed to question? Here at Alpha Index, we look for the hidden principles behind the noise. So today, we're putting gold to the test. We'll strip away the emotion and look at the cold, hard data to answer one question. Is gold the key to protecting your wealth? Or is it the modern investor's Midas touch? To understand gold as an investment, we first have to understand what it actually is. And the truth is, it wears many hats. You can think of it as having 4 distinct faces. First, there's the tool. About 7% of gold is used in industry dentistry, and especially electronics. The phone in your pocket contains a tiny amount of gold because it's an incredible conductor that doesn't corrode. But let's be honest, nobody is buying gold bullion because they're optimistic about iPhone sales. Its industrial use is a footnote, not the main story. Second, there's the symbol. This is the biggest use case, making up nearly 50% of demand. Jewelry. In cultures across the world, particularly in India and China, gold is the ultimate expression of status, security, and celebration. This cultural demand provides a solid floor for its price, but it's driven by tradition and sentiment, not by financial fundamentals. I'd classify this as a collectible, much like a piece of art or a luxury watch. Third, we have the fortress. This is the gold held by central banks and institutions, about 37% of all the gold ever mined. This is the ultimate just-in-case asset. We pull it out of the ground at enormous expense, refine it into bars, and then put it right back underground in a vault. It's a fascinating display of human psychology, a global consensus that these shiny bricks hold inherent value, a backstop against the failure of our entire financial system. And that brings us to the fourth phase, the one you're here for, the speculation. This is the gold bought by investors like you and me through ETFs, coins, or bullion. We aren't making jewelry or running a country. We are making a bet that in the future, someone else will pay more for this metal than we did. So, how has that bet paid off? An investment can only be judged by comparing it to its alternatives. This is the principle of opportunity cost, the silent tax on every financial decision. Every dollar you put into gold is a dollar you didn't put into stocks, bonds, or real estate. So let's run the numbers. Let's compare a 10-0 investment in gold against a 10-0 investment in the S&P 500, which represents the 500 largest companies in the US. We'll start in 1971, the year the US officially severed the dollar's link to gold, allowing its price to float freely. As you can see, it's not even close. Over the long run, the S&P 500, powered by innovation, profits, and reinvested dividends, has created vastly more wealth. That 10-0 in the S&P 500 would have grown to over 4.5 million. The same 10-0 in gold would be worth about 650. That's a massive difference. But the chart reveals something else, something crucial: gold's volatility. Look at this period from 1980 to 2000. For 20 years, gold was in a brutal bear market. It lost over 60% of its value and didn't reclaim its 1,980 peak until 2007. Imagine holding an asset for 2 decades and having nothing to show for it while the stock market was roaring. That doesn't just test your portfolio, it tests your discipline, your conviction, and your sanity. The fundamental difference is this: a share of stock is ownership in a productive business that generates cash flow. It grows, it innovates, it pays dividends. Gold, by contrast, just sits there. It produces nothing. Its only hope for a return is that the next person is more fearful or more optimistic than you are. Okay, the gold advocate will say. But you're missing the point. Gold isn't for growth, it's for safety. It's a safe haven for when everything else crashes. This is the most powerful part of gold's mystique. The idea is that when stocks fall, gold will rise, acting as a financial counterbalance. But how true is that? Let's look at the data. A study published in the Journal of Finance examined monthly returns and found that in 17% of months where the S&P 500 fell, gold also fell. 1 in 6 times when you needed your safe haven the most, it wasn't there. Think of the COVID-19 crash in March 2020. In that initial panic, what did gold do? It sold off right alongside stocks. Why? Because in a true liquidity crisis, people don't sell what they want to. They sell what they can to raise cash. Gold's reputation as a safe haven is based more on psychology than on reliable performance. During a crisis, fear takes over. People flee to what they've been told is safe for centuries. This massive influx of panicked buyers can create a self-fulfilling prophecy, driving up the price. But as we've seen, it's not a guarantee. If you truly want a safe asset to protect against stock market volatility, the boring but true answer is high-quality government bonds, like US Treasuries. They are historically far less volatile than gold, and they pay you interest. They are the logical choice, whereas gold is often the emotional one. Finally, let's tackle the most common argument you'll hear today. Gold is a hedge against inflation. The idea is that as governments print money and devalue their currency, the price of real money gold must go up to protect your purchasing power. This belief is a ghost of the gold standard. It makes intuitive sense. But once again, the long-term data tells a different story. Researchers at Duke University found that over the short term, the correlation between gold and unexpected inflation is nearly zero. Sometimes they move together, sometimes they don't. In the 1980s and 90s, inflation was falling, and gold's price was also collapsing. Think about it from a global perspective. The price of gold is set on a global market. A surge of inflation in the United States doesn't automatically mean the price of gold will rise to protect American purchasing power. The price is influenced by demand from Indian jewelry buyers, European central banks, and Chinese investors just as much. The bottom line: while gold has had periods where it outpaced inflation, it is not the reliable one-to-one hedge that many believe it to be. So, after stripping away the myth and the emotion, what have we found? From a purely financial standpoint, gold has serious drawbacks. It generates no income. It has no yield, no dividends, no rent. It is a sterile asset. Its long-term returns have dramatically underperformed productive assets like stocks. It is surprisingly volatile, with the potential for decades of stagnation. And its record as a safe haven and an inflation hedge is, at best, inconsistent. Here at Alpha Index, our philosophy is centered on acquiring cash flow producing assets that compound wealth over time. For that reason, I personally do not allocate a significant portion of my portfolio to gold. The opportunity cost is simply too high. Now, this doesn't mean it's useless. For a person managing immense wealth, a small allocation might act as a form of chaos insurance. But for the average investor trying to build wealth, the historical evidence suggests your capital is better deployed in assets that actually do something. The wisdom of King Midas isn't that gold is evil. It's that you must understand what an asset's true purpose is. Gold is a magnificent symbol, a useful commodity, and a powerful cultural touchstone. But as a long-term investment for building wealth, its shine has been tarnished by the performance of superior alternatives. What are your thoughts? Is gold a critical part of your strategy, or do you agree with our analysis? Let us know in the comments below. If this deep dive into the principles of investing brought you value, please give this video a like and share it with someone who might be wrestling with this question. And for more content that cuts through the noise to find the hidden wisdom in finance, make sure you subscribe to Alpha Index and hit that notification bell. Thanks for watching.